Thanks for coming. We're here to talk about the sexy world of cost basis, and I'm sure most of you already agree that it is sexy. But if you don't, I'm going to demonstrate why, why it is. So first, let's answer the question: what is cost basis? So everybody in the company kind of knows what cost basis is, but what we found in the industry is everybody kind of knows what cost basis is. Just in case you're not clear, this is what cost basis really means. So in book accounting, if you have, in this example, you buy 100 shares of ABC Corp at $20 a share, your cost is $2,000. Seems pretty simple. In the cost basis world, you have to account for any adjustments to the cost basis. I skipped what cost basis is. It's the cost of investment for tax purposes. That's the key. So in this example, same example, buy 100 shares of ABC Corp, $20. Your cost is $2,000. But let's say you had previously sold that same security for a loss. This is where a wash sale comes in. The IRS says if you sold it within 61 days, either side, 30 days either side of the replacement shares, then that loss is deferred. So if you had previously sold it for $500, your adjusted cost basis is now $2,500. Then let's say that security, ABC Corp, spins off XYZ Corp. You'd receive 25 shares of XYZ Corp and some portion of the cost basis. So in this case, we're going to say it's $2,500 or $250. So now you still own 100 shares of ABC Corp. Your cost basis is lowered by the $250, and it's allocated to your 25 shares of XYZ. This is where it starts to get messy for people. Then maybe ABC Corp has a stock split. That actually won't change the cost. Their cost is still $22.50, but now you have twice as many shares at half as much on average cost per share, and your XYZ doesn't change. So on the book side, this is all the math you have to do. On the cost basis side, first of all, you have to track all these events and then do the math. So that's where we come in. Now,
be in front of the camera.
oh, hi.
Your laptop is the camera.
Oh, sorry. Too many cameras. Okay. So when investors brag about their wins and losses, they always refer to P&L, right? Oh, I bought Google at $70 or at $700, and now it's traded at $1,000. I have 100 shares, so my gain on that is $30,000. I have $100,000 cash if I sold this 100 shares times $1,000 a share, $100,000. This is what you always hear about people in the gym when they have these big wins. They brag about this. What they don't brag about is your gains and losses. So from what really matters is your after tax. So in the same example, you sell Google at $1,000. Your gain loss is still $30,000. That doesn't change. But now, if it's long term, now you're paying taxes, $7,000 in taxes. So your cash is now only $92,000. But it's worse if it was a short term investment. Your taxes go up to $13,000, and now you only have $86,000. So now you can start to see how cost basis impacts your tax. By the way, these numbers here assume that you're in this middle bracket for tax purposes, and it also includes the net investment tax, which is associated with Obamacare, another 3.8% on top of the capital gains rates. You don't need to remember that; it's just full disclosure on how we did the math. All right, so here's how cost basis can be used to an investor's advantage. Let's say you have $10,000 in net gains as of December 30th. So if you don't do anything else, and you're in the 35% tax bracket, you're going to pay $3,500 in taxes. But let's say that you still own, you haven't sold, you still own Comcast. It's had a pretty bad year. You own 500 shares. Your cost on Comcast is $75, but it's only trading at $40. If you do nothing, then there's no impact on your portfolio or your taxes. You still own this. If it goes up, you make more. If it goes down, you continue to lose money. But there's really no value holding it in the portfolio. On the other hand, if you were to sell it, if you sell 372 shares, you take a $13,000 loss. Now, losses always sound like it's a bad thing, but from a tax standpoint, losses are good. Because what happens is your portfolio value has not changed. You've sold 372 shares of Comcast. You've lowered your security value by that $14,000. You've added $14,000 from the sale in cash to your portfolio. So there's no change in your overall portfolio value. But what you've done is you've offset this $3,500 gain, or taxes you'd have to pay on the gain. Plus, you can take a $3,000 loss. So at the end of the year, instead of paying $3,500, you'd save $4,550. So that's what's called tax loss harvesting. That's the thing that most people think of when they think about tax management. I thought I'd just throw up some numbers on the history of U.S. capital gains rates. They're about to change again if Trump gets his plan. But to give you some perspective on the history, capital gains rate was introduced in 1913. Prior to that, it wasn't taxed. It was taxed at 15% when it was introduced, which was actually higher than the top income rate at the time. It's kind of interesting. 1917, World War I, was not a good time for taxation. The taxes jumped to 67%. In 1922, they introduced the concept of a longer holding period. So if you held something for 2 years, it'd be taxed at 12.5% as opposed to 58%, which is what the tax rate was still in 1922. In 34, they actually made it even more complicated. Different rates if you held something for 1 year, 2 years, 5 years, 10 years. Even more complicated than what we have today. Today we have 3 rates for long-term capital gains. 0 if you're in the lowest bracket. I'll talk about that in a minute. 15% for most investors and 20% at the high end. So that's for long-term capital gains, if you held something for over a year. If you held something for less than a year, you're taxed at the nominal income rate, and the highest rate there is 39.6. It's actually 43.4 if you add that net income tax that I mentioned, 3.8% net income tax. So the basic point here is rates change all the time. Short-term rates, long-term rates, the number of brackets, the break points for each bracket. They're going to change again probably next year. One way or another, we're going to have different tax rates. That also becomes important when you're talking about tax management, because sometimes it makes sense to sell something this year because the rates will be higher or lower, or sometimes it makes sense to wait until the following year when tax rates will change. All right, so fundamental tax management principles. And by the way, all of this relies on an investor understanding their cost basis, or you can't do any of this. And that is the sexy part about the cost basis. So money in pocket matters more than pre-tax gain loss. Again, gain loss without taking tax into account is just bragging rights at the gym. What really matters at the end of the day, did you have $100,000 from selling Google, or did you end up with only $87,000? Obviously, you do want to have the $100,000. A short-term gain, which could be taxed at, say, 15%, short-term gain would be taxed at nominal tax rate. That can often be twice what it would be taxed at long-term. We're going to talk about that in a minute. So just the timing of selling something right before or right after it becomes long-term is critical. For lower brackets, you could actually pay nothing on capital gains if they're long-term versus paying 15% if they're short-term. Another concept is better to have money today than tomorrow. So it's better to pay taxes tomorrow than today. So as an example, wash sales, I mentioned them earlier, that defers a loss, which essentially increases your taxes. You'll eventually get that loss back when you sell the replacement shares, but all things being equal, you'd rather have the money today than 3 years from now. And all of this gets to poor tax management, leads to poor after-tax investment performance. So here's some of the tools that help in tax management. These are things that we've built in the world's greatest product that doesn't exist, Scope Tax. The tax loss harvesting example I gave earlier, which is really just like it sounds, really harvesting losses to reduce your taxes. Tax year deferral, basic concept that a lot of investors don't take advantage of. You sell something for a big gain in December, you're paying taxes for that 4 months later. You wait till January, you've postponed this. You're still going to pay the taxes, but you've postponed it for a year. You can invest the tax equivalent in anything and benefit from that. Wash sale avoidance simply says wash sales again defer losses, which increases your taxable rate. Avoiding those wash sales will minimize taxes. If you do want to sell something, if you want to do tax loss harvesting, sort of the one caveat there is that if you're following the robos, they're all getting into automated tax loss harvesting. So every time, if you invest in Betterment or Wealthfront, every time a position drops by 5%, it'll automatically sell that and buy another security. What they do is they have A security, B security, C security. So when you first set up your portfolio, they put you in A security. If that drops 5%, they sell that, take the loss. Now they can't repurchase that security because that would be a wash sale. But they can buy another similar security, so they'll buy the B security. Sounds okay, except do you really want the B security? If Google is the A security, or Amazon's the A security, do you want the B security? Probably not. There's some other issues that or reasons why automated tax loss harvesting may not be as good as it sounds. But a lot of these other things clearly have a lot of potential. Actually, I shouldn't say tax loss harvesting does have potential, but the automated version of it probably takes too much control out of the investor's hands. So this is the scope tax what-if analysis. I can't go through all the tools we have, but just one basic example. What the what-if tool does is let an investor who's about to make a trade, lets them see the tax impact of that trade. It'll also look at all the other tax lots for the same security within the portfolio to determine if there's a better lot to sell. So in this example, the investor is going to sell a lot that would trigger a loss of $10,000. Now remember, again, from the tax standpoint, losses are good. Sounds good. But there would be disallowed loss. So this would trigger a wash sale, disallow that $10,000 loss. So the reportable gain, the impact on reportable gains, no impact. At least it's not a taxable gain. So it's not awful. But there's another tax lot that would generate an $11,000 loss without a wash sale. So that would lower the taxable income for this investor, so it's a better trade. The investor could switch to the alternative trade that scope tax recommends, or they could stay with their current trade. This kind of tool is not something that an active investor would ever care about, and it's not something that a broker would put in the trading path for an investor. But it is definitely a tool that an investor could benefit from if they said, okay, on this trade, show me the tax impact, show me if there would be a wash sale, show me how long until that wash sale window goes away, and show me if there's a better tax lot to sell. And the impact from a performance standpoint is nil. So if I switch to this alternative tax lot, it's the same lot security. So I'm selling, in this case, I'm selling Microsoft. I'm still selling Microsoft. So I haven't really changed my sell or my investment strategy at all. I'm just picking a different tax lot that leads to a better tax outcome. All right, here's a sizzle. So these are the tax brackets, and I don't know if you guys can see this, but there are 7 of them, and I just picked the middle rate here. So if you make between $91,000 and $191,000 a year, if you're an investor that was in that bracket, on a long-term trade, so something I've held more than 1 year, I'd pay 15%. If I sell something short-term, less than 12 months, that's 28%, roughly twice as much. On a $10,000 gain, the difference between the short-term rate and the long-term rate is $1,300. So everything else about the security, same security, same selling price. But this is something you might think about right when it's going from short-term to long-term. So I've held it for 11 months. I'm thinking of selling the security. If I wait, and it's a gain, $10,000 gain. If I wait one more month, I'll save $1,300. If you were to do that if an investor was to do that one time a year for 20 years and just took the $1,300 each year and put it in something that would generate a 5% return, the impact over 20 years is $42,000 to $43,000 almost. And they have not changed their investments. It doesn't impact any investment strategies. It's just paying attention to securities that are approaching long term and waiting until they go long term to take the gain. If you do that one time each year for 20 years, and the amount you're saving seems relatively small, $1,300. Over 20 years, that's $42,000. So you're probably asking, Eric's probably thinking, well, yeah, how often does this actually happen? So I'm glad you asked, Eric.
Why didn't you ask my question?
I heard you. So here's bad behavior in the wild. So we looked at a couple firms, a couple of our clients, and we looked at trading activity between 2014 and 2016. We looked at closing activity, so things that investors had sold within 30 days, either side of going long-term. So we looked at gains that they sold when they held the security between 335 days and 365 days, within 1 month of going long-term. So they sold them when they're still short-term, paid the higher tax rate. We also looked at losses that were sold immediately after going long-term. The benefit of a loss is that it offsets gains. So you want to take losses short term. So if you sold something one day after being long term, that was a bad decision from a tax standpoint. So we looked at the activity across for just 2 clients. First, at the gains taken within 30 days of becoming long term. The biggest trade we saw was a single trade for $3 million. They had a gain. Congratulations, they had a gain $3 million. If they waited a month, they would have saved $589,000 in taxes.
It was Misha's account.
Yeah. So from a single trade, now granted it's a big number, but from a single trade, they overpaid in taxes by almost $600,000. I don't know if you can see this in the back. Across these 2 clients, $514 million in gains were taken within 1 month of going long term, with a net impact of $93 million in additional taxes paid. Again, you couldn't use this strategy for every single trade, but clearly it happens enough where even a portion of these, if the investor had waited, and I'm not saying it's always 30 days, it could have been 1 day before going long term. If they had waited in these cases until the security went long term, they would have reduced the taxes $93 million. And this is just 2 of our clients. And we also look at the losses. Again, if it just turned long term, then you've lost the ability to offset short-term gains, so you're effectively paying higher taxes. We had one investor that, on a single trade, lost $1.2 million, which sucks. But what sucks even more is that they paid an additional $216 tax. Awesome, Misha. Yeah, but he made the $3 million on the first trade, so he's okay. So not only did they lose $1.2 million on the trade, they ended up paying $216,000 more in taxes than if they had sold this when it was still short-term. And across the entire database for those 3 years, not across the entire database, just for these 2 clients, for those 3 years, total of $732 million in losses, which translates to $132 million in excess taxes paid. Add those together, $225 million in additional taxes paid, the potential additional taxes paid, than if they had been paying attention to the holding period. Now, those of you know a little bit about tax management. There are really 2 types of tactics in tax management. One which simply takes advantage or avoids deferring, or either defers the tax payment or avoids deferring a tax reduction. The net outcome is eventually 0. So, for instance, if I have a wash sale deferral today, then I lose the ability to take a loss. But when I sell the replacement shares, I'll get the loss back, the full amount. So it's a time element, where instead of getting the advantage today, I get it in the future. In this case, you've lost the opportunity. Once you cross the short-term, long-term threshold, you immediately go from paying 15% to paying whatever the nominal rate is, 35%. And it never comes back. So you've immediately lost this opportunity, and you'll never regain it. This alone is the key reason why investors should care about tax management. That's it. Cheers.
Question.
Yeah.
So a short-term loss can offset a long-term gain, or no?
First, a short-term loss offsets first the gains, and then if you have anything left over, you can offset the long-term.
Okay, so the short-term loss can be used against either one.
You have to deprecate your short-term gains first, and then if you have a remainder,
Well, you would rather do it anyway because their entire tax.
But you can't do the opposite if that's where you're going next. You can't use your long-term losses to offset your short-term.
Right. Yeah. Right. That's what you were getting on that. But I just wanted to know if it worked the other way. Yeah.
Yeah, and also, by the way, you don't. If you had, like this person had $1.2 million in losses, that's for one trade. Let's say they had $1 million in gains aside from that trade, they'd still be left with $200,000 they could apply to future gains. So even if they can't immediately use the offset,
Okay, so you carry over losses.
you
right?
carry it over.
Yeah.
They'd be able to recognize $3,000 each year until they use it all up, but they could also apply the loss to future gains.
So if you have a loss, it's about to become long-term. You should just sell it no matter what.
If you're going to sell it anyway. I didn't put the standard tax caveat in here, which is, don't your investment decisions should not be made solely upon
selling it and then buying it right again.
without being a wash sale.
But at least you could still hold on to it.
You could do one of two
You'll
things.
keep it
So if you want to sell
right.
something for a loss, you could either wait 30 days afterwards and buy the same security back without having a wash sale, Or if it's something that's kind of a commodity, like if you're in Mobil, Exxon Mobil,
Yeah.
and you want to take a loss and buy back Shell, that's
Yeah.
probably pretty reasonable, right? Or if you're, this is a little bit of a gray area, but if you're in a Vanguard index fund, sell that for a loss, you might, this is the gray area, but you could buy the same index fund from
Right.
Barclays or from someone else. Now, some tax accounts would say if the holdings are the same, then it's substantially identical, which is actually the term the IRS uses. Substantially identical. They don't say identical.
So index funds can
be, yeah.
technically be a wash sale.
Yeah,
and
so
a
that
fund.
they will
Sure.
actually. There's actually analysis done on holdings that says, and the IRS never gives you a threshold. So, you could say that 90% of the assets in this fund are the same as the one in this fund. But there's no way to determine if the IRS would consider that substantially identical or not. They don't say if 80% of the assets are the same,
Right.
it's substantially identical.
But if you had like 2 S&P index funds, there's no way that would be allowed.
It's highly unlikely. Well, no, it's highly unlikely that unless you did something else that would trigger a red flag,
Yeah.
that the IRS would crack down on that. If you
Oh.
sold, if you sold the Vanguard S&P 500 index and you bought back a Schwab S&P 500 index, chances are the IRS isn't going to. They have the symbols and they have the descriptions. They don't have an algorithm that's going to compare the holdings and come back and go, Nick, they're the same.
Well, there's 2 different questions. Are they going to catch you? Probably not. But is it technically allowed? No, right?
The answer to the first one, no. The answer to the second one, yes. Yes, they're probably not going to catch you, but technically you're buying the same security. Substantially identical.
Yeah.
Find in the wife's name.
You can try that, but if you're filing jointly, the same issue.
When the hell did this become a tax cheat class?
So there's actually a quote.
Isn't that what cost basis is about? Being a tax cheat?
It's all about
Wait. Who said that's why it's sexy? Because there's cheating involved, it's sexy?
This is what makes it.
There's a quote by a judge in New
Wait, you
York
said
judge.
50 Shades, which implies kind of,
That's gray area. That's
gray
gray
area,
area.
right? It's appropriate title.
There's a quote by a 20th century judge from New York, Judge Lernenhan, and he said that he's a tax lawyer, and he basically said, to paraphrase, it's your obligation to pay taxes, it's not your obligation to overpay taxes. So it's fine to find every single loophole, it's not cheating. As long as you stick to the regs.
It's not tipping, I believe. It's over.
Any other questions on
Write
cost
that
base? I'll send you the official quote. Any other questions on what's that?
Following the leaves of President Trump, right?
Oh, jeez, that's not
The
good.
same
There. Any questions on tax management, cost basis, short-term, long-term holding?
I have a ridiculous question for this group. Is there anyone here, since Cameron uses a lot of terms and it runs by very fast, who does not know what a wash sale is?
I now know. I've never known.
Come on, someone else must not know. Because it's not something you would stop and think about. Come on, somebody be there. Thank you. All right, so what happens is it's actually related to tax loss harvesting. So just like tax loss harvesting is harvesting losses to reduce your gains. So people would sell something, take the loss, and then buy it right back. And the IRS says, no, that's an artificial trade simply to reduce your taxes. There's no investment decision or investment
Motive.
value there, right? So they said, okay, if you sell something for a loss and repurchase it within 30 days, the loss. Now they said the loss is disallowed. That's actually misleading because it's just deferred. It's not gone forever. Just you're not allowed to take it until you sell the shares that you bought back. But that's 30 days either side of the replacement shares. Replacement shares are to sell something for a loss. The shares I buy back are called replacement shares. So those replacement shares, if I buy it back within 30 days of selling the loss, which ends up being a 61-day window, the day of the loss, 30 days either side, that becomes a wash sale. And what happens is your loss, I took a $10,000 loss on this trade. If I buy back the same security tomorrow, then my loss is deferred until I sell the shares I bought tomorrow. So I will eventually get the loss back, but there's a time element there where it could be a year from now. The other thing to keep in mind, this is what Nick was
What if only
talking
bought
about.
back half the shares?
And it's a half wash.
Yeah. See, this is why cost basis becomes so much fun. It's all these little pieces you got to fit
And
together.
clients like you were a pain in the neck.
But Nick, what we were talking about a minute ago is that the IRS makes it even more complicated because it's not just buying back the same shares, it's buying back the substantially identical shares, which they don't define. So substantially identical is a phrase no one would ever use except for the IRS, and they don't help us by defining what substantially identical means. But that, essentially, they're creating wiggle room for them to say, Nick, you sold Vanguard S&P 500 shares and bought Schwab S&P 500 shares. It's the same index. So that's why they call it substantially identical. Taken to extreme, they could also say options are substantially identical. It doesn't happen often, but there are, particularly with manufactured securities, where you can basically recreate a security by bundling options and stocks to recreate exactly the same performance as a specific security. Substantially identical allows the IRS to include that type of activity as well.
Are most of our Maxic clients using the tax planning tool of this?
None of them are. So, yeah, so we haven't built, so we talk about scope tax a lot. We haven't actually built scope tax. We've built pieces of it. So this does exist. We built pieces of it. We have, all of these are tools, and there are a few others. And we have some of the requirements. We're hopefully going to get this thing started soon. We need to rebuild it. Built the building blocks like 4 or 5 years ago. So we want to update some of them. We've got some new ideas. We also want to do a different presentation style. But the real holdback has been our clients have been really consumed with rolling out the regs. And we just rolled out the last piece, the fixed income more complex. Up until now, anytime you try to have a conversation with anybody in cost basis, I can't get my head around anything other than the regs right now. Well, we're done with that. The other thing is that it's not the same buyer. So folks that buy cost basis are typically operations folks, tax folks. These tools are really, the buyer here will be very similar to a well-scoped buyer. So same people who are looking for performance tools, risk management tools. That's where this comes in because it's more of a trading tool than it is a tax tool. Any other questions?
Is it allowed to make suggestions like, oh, if you wait like 30 days, you will get like less tax? Or
Yeah. So when we part of the challenge in designing this and presenting it to the client is how we convey the information. So we can't give tax advice, right? We can't say do this because of that. What we can do is kind of outline if you did this, this is what would happen.
okay.
So it's subtle. But we don't want to cross the line where we're giving tax advice.
You can illustrate the differences, but you can't say you should do the one that makes you
Now,
more
Nick,
money.
here are the 3 choices. Pick the one, and you see the outcome on all 3. Pick the one that makes the most
Save
sense.
$1,000, pay $500. You know.
Yeah. So, but that's an important point because we cannot be in the business of giving tax advice. And our clients, the firms that would be providing this to their investors, are even more, scared about the perception of giving tax advice. So it's more about presenting the information back. And one of the things about tax management that makes it so valuable is it is really the most dependable investment strategy. So if you read research reports, if you've read enough of them, you know they're all BS. So some analyst comes out and says, you know what, we're now pegging Apple to go at 100. Like, well, it's been 140 for a couple months now. You know, how gutsy is that? Or they say it's going to go to 160, it never does. You don't know, right? It's research or a trading tool that predicts that, reads the charts, a charting tool. It says, okay, it's hit, I don't know anything about charting, but it's basically trying to find patterns to predict where it's going to go. Everything in tax management, if it's done properly, is based on facts. So here's what you pay. We know what you pay. Here's your cost basis. Based on the market price today, we're not saying if it goes up $10. We're saying based on the current market price. If you sold right now into this market, this would be your proceeds. This would be your tax impact. And there is some information the investor has to tell us. So we don't know the tax bracket. We don't know if they're filing jointly or individually, right? That matters. We don't know what state they're in. They have to tell us that, and then we can factor that into the analysis as well. Again, it's all fact, and we're just presenting it back so the investor can make their decisions based on the information in the system.
Are there many state-level taxes on
Yeah, so
investments?
Massachusetts, 6% on top of this, 6%. Basically for an investment, you have, if I were in the top bracket, which I'm not, but it'd be 39.6% for the capital gain, 3.8% for the net income tax, and another 6% for Massachusetts. So I'd end up paying almost 50% of the gain. And every state, I mean, New York's worse, right? So New York's taxes are even higher. What is it?
New York has it's almost 10.
Almost 10.
Almost 10. So
City
I think
awards.
on top of
Yeah.
the 15, so just more 20.
So actually, and so some of that is in.
Use what if, huh?
So that's what this is. Future income tax rate modeler basically allows the user to say, okay, well, so the rates are going to go from 35% to, I can plug in, I think it's going to go to 30%. So I can start to profile a future state based on changes to tax law, or if I were moving from New York, which has 10%, to Florida, which has 0, or New Hampshire has 0, I can model that too. For some people, it may make sense to move, but even if it doesn't tell them to move, it might say, well, I should wait till I move to Florida to sell this security that has a huge gain. So there's a lot of information that investors aren't active upon. And really, none of the math is particularly hard. It's just combing through all the data, adjusting for the cost basis, which we're already doing. Pulling all the data together and presenting it back in a way that is not giving advice, but is easy to understand and act upon. All right, thank you.
Thank you.